Welcome to today's information session, where we're going to be discussing the SocGen electric vehicles enhanced opportunity. We were originally going to launch the miners growth note, but when this came along, we really felt that it was just, we had to share it. And you're going to soon see why as well. With regard to the miners, we are planning on launching that note probably in July, so it's still going to be coming along. This product targets a quarterly return of 5.5% per quarter, 22% per annum in US dollars, until it auto calls or it reaches full term. In this session, we're going to be covering the terms and conditions of this particular investment opportunity. And for any newcomers that are here tonight, that would like to understand how structured notes work and how they can deliver the returns and protection that they do, drop us a mail on support@Cashbox.Global and we will be in touch. Alternatively, in the chat, you can just pop a note in the chat and we can organize that for you. Then just some housekeeping. So Cashbox.Global is a financial services organization and we are registered in Mauritius and South Africa too. So that's great. And we design and provide global investors education and access to defined investment contracts called structured notes, which target the same returns and capital protection normally only available to large investors. Cashbox.Global does not offer investment advice, nor do we make any recommendation regarding any investments. All the information should be read and understood before making any decisions. The investors should seek suitable financial advice before investing to ascertain the full risks and terms associated with the investment. While Cashbox.Global structured notes have a strong track record, past performance is no indication of future performance. Then before we get started, I just want to let our Cape Town community know that we are going to be hosting an informal meetup on Friday, the 26th of May at 10 at the Peninsula Hotel. So if you are in town and we would love to meet you in person, please pop your details into the chat or you can email me. And so with that, I'm sure you're now quite intrigued while we switched notes at the last minute. So let's get started with Andrew.
How's it, guys? From always a dark and pretty cold Cape Town, hence my outfit tonight. So I'm really excited about this, and I was told by a few people, well-placed people in the Cashbox team, to stop waffling and get on with it. Otherwise I should go and do something different, which quite a few things spring to mind. But I'm really excited about this. We had a presentation to an Australian community on the miners note. We were all set to go. It's still a great opportunity, and we're going to probably go with that in July. But this creation, we were invited to participate in, and it really is a glimpse, I would say, into, and forgive me if I'm stepping on anybody's toes here, but this is a glimpse into what the ultra high net worth client base anticipates and expects in terms of the type of product, in terms of the bells and whistles that the product normally comes with. This is absolutely loaded. You look at this page here on screen, and it doesn't say a heck of a lot, except for a really sort of headline grabbing 22% US dollars per annum. It's an income product. It's paid 5.5% quarterly. Excuse me. So this is something we haven't seen since probably, 2020, 2019. It really is quite exciting. It's got a great issuer, SocGen, Societe, Generale. We'll go through that. And we are staying with this thematic approach. Cashbox really tries to stick to its knitting, to use an English sort of phrase, trying to connect and link things, to have resonance with what's going on around us in the world. And what's going on around us in the world has been evidenced in the last few products. It's all about clean energy, the global move to sustainability, the disconnect from hydrocarbon fuels, fossil fuels, oil, gas, all that kind of stuff. But it takes time. And some of those trends have been evident. The sub-trends have been electric vehicles, wind power, solar power, etc. And we've embraced these and we've launched them out in various types of notes. So thematically, we're staying true to our compass in terms of what makes sense. Where the trends grow, you have to stay with those trends. These are new trends, very powerful trends with long cycles. I'm delighted to have Graham McCallan from IDAD. He's sitting on the rock in the middle of the Irish Sea, but he'll add some more input into it later. So it's a great product, and this screen doesn't show a heck of a lot, but it is packed. I'm so excited. This product is absolutely packed with new features. I saw in the invite going out, there were these little blocks that says new, 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 new. And they really are, for very many people, new opportunities, new product features that literally pack this particular thing into this box, and it's bulging with good stuff. So I'm going to get into the product now. It's a little bit different. What I'm going to do this time is just explore a little bit about the actual companies and why there's so much excitement around them. I think we need to preface and position, give context to why this electric vehicle theme and trend is so strong, because we've launched electric vehicles before. They've done pretty well. But certainly as we move through this clean energy field, what's happening with the Paris Accords, it's something that's going to be part of our lives. We need to embrace it. And because it's got such a headline grabbing coupon, I keep coming back to this 22% per annum, 5% per quarter, 5.5% paid away. So it's an income, it pays up. So people who are cash flush greedy, people who need cash, this is something that really needs to be, you need to concentrate now and pay attention. So let's go on to the next slide, if you may, Jill. Okay, so here we go. Most people may have seen electric vehicles. They've got this big plug-in PowerPoint. The company just selected an old favorite, Tesla Motor Corporation. We have a Chinese upstart, if you may, in NIO on the bottom right-hand corner, and Rivian, which is a 9-year-old company out of the USA, mainly on the more heavier commercial electric vehicle applications, commercial trucks, delivery trucks, that type of thing. So yeah, these are certainly players in this mega trend. Now, certainly I'm going to go through the actual companies themselves, not in terms of huge detail. There's a rationale that I put out with the help from the IDA chaps as well, in terms of building the story and why this makes sense. Now, you just got to please just take a step back, and I'm going to slow down as well. A structured node is not designed to shoot the lights out in terms of unlimited upward growth. These companies have been selected because they are opportune right at this moment. Okay, we have a contracted return of 22% per annum, 5.5% per quarter. That's contracted. So if they do better than that, fantastic, happy days. Okay, but we don't participate. We are contractually defined to this playing field. What's more important about this particular deal, because we've got some spice in here, if I can call it that, in terms of these particular companies are not slow plodders. They're exponential up and down type of growth vehicles, influenced by all sorts of headwinds and tailwinds. So we needed to build in all sorts of protection, and you're going to see that jam-packed box that I've been talking about, that's going to be coming out. But certainly this particular, we'll talk about the company just now, the Societe Generale, the issuer, the bank. These type of companies are in a trend at the moment that is not going away. This is not a pandemic darling kind of situation where, because of forced circumstances, they shot up and then they collapse. This is a long cycle. It's very much like commodities at the moment, the banking cycle that we were looking to launch. That's going to be around for some time. These are long cycles in terms of delivery, in terms of you talk about a number of years, if not decades, in some instances, as we transition to a new way of energy production and energy usage in terms of automotives. So these are the type of companies. There are some left field issues here. And if I had to say what the biggest issue was, as I said, we're not trying to shoot the lights out with these. We're just wanting to make sure that these actually, in fact, just bumble along. We're quite happy with that. And you'll see now, Chad's our statistician in terms of charts, and he's the chartist in the business, and he'll take you through that. But certainly, the slides come later, but certainly we want to make sure that are we accessing these at the right stage, and you'll see some of the graphs that we put together and are backed by Wall Street analysts and backed by what I've called, this is my new slide that I'm very excited about, the green flag situation. Why are there green flags in terms of these products being appropriate? In South Africa, we've got a particular gent who goes around and he talks about red flags and green flags in terms of, is the scenario planning right? Are the green flags there? And we're going to try and mesh that together a little bit to make sure. But certainly this is a global basket. We're talking about geopolitical stresses and tensions, and we've all felt it this year. whether it be a war in Ukraine, whether it be the supply chain blockages out of Europe, out of the world, out of the global economy, in fact, following the hangover of the lockdowns in 2020. The spikes in certain jurisdictions, and then the letting go, the gilling go of the zero tolerance sort of situation like we had in China. And we got to admit, and we've got to accept that we are talking to two world economies here, the Chinese and the American situation. So if we'd like to move to a little bit what's, if you're keeping it topical, let's have a look at what's under the hood, so to speak. And I think we are on a blank screen here for some reason. There we go. Right. He called himself the chief twit at one stage when he bought, as a distraction, a company called Twitter. Most of you will know what Elon Musk is probably synonymous with the brand Tesla. He's the driving force. He's perhaps a bit of a maverick in terms of global leaders, of industrial leaders, but certainly the company that he propelled and his empire that he's propelled is very much linked to himself. And there's been a lot of talk, interestingly enough, about his succession plan. In corporate world, you always have to have a succession plan of who's going to take over. And it's been very, very interesting. You'll see one of my green flags is that not so much succession, but the fact that he's now stepping away from the toy that he bought, which was Twitter, and many investors felt that he needed to refocus and keep his focus on his first child, which is essentially Tesla. He's got a lot of other distractions, whether it's SpaceX, the Boring Company, which closed in 21 years, he called it, et cetera, et cetera. No, the Boring Company is not SpaceX, it's another company called the Boring Company. So he's an enigmatic guy, and he can say things that can move markets. And he's been gagged by regulators, and his own board want to gag him, etc. But let's have a look what the cold, analytical Wall Street guys say about Tesla as a stock, because Tesla as a stock, I can tell you. Okay, so you all look at the buy, holds, and sells, and it all looks good. It's a good value proposition at the moment, etc. The 12-month target, the consensual target, is that it should be around about 191. If I look at my trading screen at the moment, it's around about 176. So yeah, it's moved up from the last price, which we priced this on Tuesday, or I think it was Tuesday. So yeah, it's looking good. But I would draw your attention to the very bottom line, which is LTM return. Okay, in the darker bar chart. So that effectively is the number of months. Okay. The last 12 months, LTM, the last 12 months. It's lost 34%. So most analysts will say, that's a good opportunity at a discount. But it has to make sense in terms of the guidance that the company is giving and the cold analysis that an analyst would give to the company and say, okay, it's lost money. We know why it's lost money. Everybody can look backwards in the rearview mirror and we'll see why it's lost money. But is it worthwhile buying now for the future? Okay. It's like looking back in the windscreen mirror and you've done 40% plus, doesn't mean there's another 40% coming. So it looks good. The charts look good. You can see how they move down, but that last number is important, minus 34. So taking it into the green flag scenario, why do the buys and holds run the show here? So we're going to move to the next chart. I think, are you driving this show, Chad or Joe? There we go. Right. So if you go to the next one, green flags. I wonder if anybody's heard of X Corp. This is Tesla we're talking about, but who's X Corp? And who's its CEO, and why is he leaving? Okay, so very quietly in a court ruling in the US, Twitter quietly disclosed on the 24th of April that it no longer exists. Kind of unannounced, not very well known. And it is part of an entity owned by Elon Musk called X Corp. Okay, they're still going to trade under the name Twitter because it's a worldwide handle as it's known, etc. But this relates back to what I said earlier. Major shareholders, major activists, the guidance, the analysts are happy that he is leaving and he's handing over to a new leader, to his chosen successor, and he's going to refocus back on Tesla. Tesla's still a leader, but there are a lot of guys nipping at the ankles and at the the feet of the leader. It always happens. Evolution, the pride, etc. So he needs to stay as long as possible. And one thing Tesla does do is it reinvents itself regularly. What they did also, certainly this year, very aggressively in the case of the States, China, and in fact globally, I would guess, there are a few exceptions, is that they had almost a push-pull effect in terms of the second point here, a price cut and a price increase. So they saw the guys snapping at their ankles, and what did they do? They said, right, we'll just make our cars cheaper than theirs. And boom, suddenly production orders came in, production was ramped up, and deliveries happened. So he's a master. He's got he really has the art of a master in terms of reading and understanding what needs to make sales, and sales translate to earnings, less your costs, okay, for net revenues. And then what he did, once he got all the orders in, he put the price back up, okay? So it's a little bit, like it's a sale to get rid of old stock, but this wasn't old stock. This is revised stock, this is new stock, this is existing inventory as well, but not dead stock. So that was a very powerful move. And it's really been reflected in their Q1 results. He was in Paris last week. He was invited by Emmanuel Macron. France is on this like buy France at the moment, invest in France. France is desperate to have his next gigafactory. He has these factories around the world, the biggest being in Berlin and in Beijing. There's a very large facility in Austin, Texas. And politically, India is the third largest consumer of automobiles in the world. They are creating massive tax breaks and investment incentive breaks ahead of the Indian election. So somebody's looking for votes there. I was looking for the conspiracy, but it's interesting. There could be another gigafactory going up in India and penetrating a market that is not in the Tesla sites at the moment. So they're constantly reinvesting. The analysts, previous slide, they love this sort of thing. And advertising. Okay, this is interesting. Tesla last year, in 2022, spent a total of $158,000 on advertising through social media, direct, billboards, you name it, whatever medium. 158,000. That's against $370 million that Ford spent. 1.18 billion dollars that Toyota spent, and 1.3 billion that General Motors spent. And he's still the leader. They're still the leader, not just because of his charisma, because it is a good vehicle. It's had its issues and it's had its high profile problems, but they still sell the most in terms of their technology, in terms of their rollout, delivery, and sales. So if he has to transition into a marketing world, that advertising is going to be a prime driver in terms of not talking to not preaching to the converted, but preaching to the people who still need to buy the concept of electric. Very powerful, huge opportunity, massive opportunity space. And interestingly, the person who's imported, he replaced himself at Twitter or X Corp, is the ex-head of NBC, global head of ex-NBC ad spend. Linda, what is her name? Linda, not Yakitori, that sounds like something you eat. Linda Yaccarino, she was the head there. So there's clearly an influence that said you need to advertise. So that could be very, very powerful. I think the other problem that Tesla really had in 23, where you saw some of that -34 come in, was because of diminishing supply chain. That hit everybody. But the fact that he's got this gigafactory in China, it makes sense. China had that zero policy at that stage. They just locked up and they just said, nobody's working, nobody's going to work, nobody's delivering any product, etc. Plus the ongoing issues with supply chains, whether it be semiconductors, microprocessors, you name it. So product just couldn't get out to the individual, at the purchaser, to the consumer. All these convoluted contortions seem to be unraveling. These are all very much good green flags. So let's go to the next one and see how they fare. So, if we move on to our next phase, okay. Gosh, this guy looks like he's just out of school, but he's worth $1.9 billion. This is one of the Chinese centric electric vehicle makers. There's a whole host of them. NIO has been going pretty much for 2000 and about 13, 14 years. This is William Lee. Obviously nowhere near the net worth of our friend Elon, previously shown. But NEO obviously has a very interesting space. There's a pragmatic approach to communism. I love history. I love history, and I love the nuances of both the commerce, commercialism, industrialization, and how they work into cultures. And one would think that the Chinese government, being communist on the face of it, would really clamp down, but they're quite happy for NEO to go and hopefully in 2024 play in the American market. Much of his startup capital came from Chinese communist mayoral, if you want to call it, war chests. They invested in there for 1 year, made a lot of money and exited. So a very interesting company, but clearly what happened with TikTok in America could happen with NEO in America if they go to America. So I'm starting to build up this, hopefully some of you might be appreciating it, why some of the protection factors, which we will show you and Chad will elaborate on, are in this product. Because the Americans have given TikTok, for example, the mobile app application, they've given them a hard time in terms of you need to divest yourself of Chinese ownership. It's dangerous for us. We can gather information on us, etc., etc. American, the excited states, sort of paranoia. Apologies to those who live in the States. This is Montero. But I still regard some of their issues as that they're a little bit paranoid. But yeah, it could happen to NEO. That could stunt their earnings growth from a commercial aspect, and they might have to withdraw when they actually get in there. So lots of, and it could be a yin for yang. The Chinese might go to Elon Musk, who's got this big Beijing factory. So all these things add up. Let's have a look at what the analysts say. Kind of similar story, except the last 12 months are even worse for these guys. Okay? If you look at the really bottom line, the small print, I like looking at that, minus 52. So huge discount in terms of where they were at. We'll go through their green flags as well. But in general, the analysts are seeing this as value play. There's good opportunity. This is, we priced this, as I said, 2 days ago, 811. If I look quickly now, you're looking at 788. So even better premium or discount to the value. But we're not looking again to shoot the lights out. We wanted to trundle along, and the fact that we're going to show you something that's going to knock your socks off in features, this is what makes this such an important opportunity. It's a tactical opportunity because the trend is growing. So we certainly believe the analysts have got a good handle on this. We start looking at their red flag. Their green flags, right there. Beg your pardon. And what does it say? You're all reading ahead of me. Increased production, sales, and deliveries. That's the name of any company, really. You've got to produce, you've got to sell it, and you've got to deliver it to the market. Their biggest problem has been they've had a massive debt accumulation in terms of what they've been trying to do in China, for example. They've had a very, very different procedure in terms of how they are infrastructurally building out electric vehicles. And I'll tell you that actually comes out in point 4. But there's certainly, in the last 2 quarters, the debt accumulation has stopped because they've basically spent what they needed to do. So that's going to stop. So containing costs for cash flow is absolutely critical in any business. Sure, you've got to make money, you've got to spend money to make money. But once you spent it, get the reward, take it off the table and reinvest at a later stage. Critically, NEO is moving to its 2nd generation production platforms. Tesla is so far ahead of everybody, the 3rd company included, in terms of their generation, the number of models they've produced, the number of opportunities in terms of the battery supply, etc. These guys are a lot newer, but they're now moving to their 2nd generation. That's where they've been spending a lot of money in terms of debt accumulation, in terms of getting those platforms right for the delivery. So the future quarter earnings are going to be watched very closely, and a lot of attention is going to be paid for them. And if I look at that last point, fulfillment of battery swapping infrastructure, what's battery swapping? Elon Musk's holy grail, and in fact the holy grail of EVs, electric vehicles, has been to travel 1,000 miles, for using the imperial gauge of miles versus kilometerage. is to travel 1,000 miles on one charge before you have to plug in and get more life. NEO took it a different way. They said, why don't we just use it like pretend it's a service station. You drive to a service station when you're out of power or out of petrol or diesel, like we do now, and you simply swap your battery. It's like you take your gas bottle, you don't fill it up, you just get an exchange version. So they've spent a lot of money in terms of getting the infrastructure right. It's a little bit like building a house and having investments, I often say. You often find that otherwise you might end up with the fridge in the lounge and the lounge suites in the kitchen. Build a house first, and that's what they've done. They built the infrastructure, and now they're putting the product into the market so that they can go from A to B, swap out a battery, and carry on. So that's a very different model, and I think it's got great potential. So let's move on to the next guy. Okay, the next rogues gallery or famous person. Again, he looks as though he's just out of Harvard or MIT or out of his garage where he's invented something. This is the founder and current CEO of his business, Rivian, American-based, 14 years old now, the business. This is not a small business. You're looking at a 12.6 billion. This was an absolute darling. When it launched, when it had its IPO, its initial price offering, it went from around about $18 to 120. Okay, it had some massive money invested into it. The biggest being, its biggest shareholder still is Amazon. So you're talking about heavyweight investments. Amazon invested, I think, 1.4 billion in it, dollars. So, and we'll get to that because that's a hugely interesting play. The analysts are the market is very interested in. So from its high, where it actually was at one point, it was the third largest company by capitalization in the world after Tesla and Toyota. It's fallen from there. So let's have a look at that slide. Why is this I won't say a screaming buy because I'm not a broker, I'm not a stockbroker. But again, go to that LTM, minus 52. Now, these numbers are important, these minus 50s and minus 40s. Because if you were an investor in these companies, you would have lost half your money had you invested 12 months ago. Horrible investment. Okay. Now it's probably a value play where you could buy it in if you were a single line equity stock investor. So all these screens are showing the same sort of thing. We're kind of hitting the parable of buy at the bottom if you're an investor and hopefully it moves up. We've had interest rates, we've had inflation, we've had a war thrown in, we've had geopolitical threats and stresses and headwinds. It's been an awful 2022, and 23 hasn't been much easier, although it is easing. Interest rates are slowing down. The war seems to be, it's going to end up in a big punch up, but hopefully we'll have a winner and it won't expand. The US, being the world's biggest market, causes headwinds. So we've got this this debt situation of can they pay their public servants? This debt seems to be every day it's getting closer, but I also say every day they still haven't got a deal. But will it happen? If it doesn't happen, it'll cause problems in the world. But again, if I look at their last price, Rivian is now 13.45 odd. So they're hanging in there, but the 12-month targets look good. But what I'm saying is they've all been through attrition. Let's look at why the guys are saying, Richard Scaringer's company, Rivian, is looking good. Their biggest issue has been cash burn. They have spent so much money. From an IPO of $18 to get up to 120, they had so much money thrown at them, and they've burnt that money. They had a massive cash burn, whereas NEO had just debt accumulation. They didn't have money; they just took on debt. Okay, so different accounting principles here. But their Q1 results were very, very interesting. They missed their earnings, but their revenues were greater because they've been doing massive 0.2 cost cutting. Last year, they cut their workforce by 6%. Just in Q1, they cut it 6%. So they're containing costs, and it comes back to my cash flow. Positive cash flow means happy investors and happy shareholders. So very, very important, addressing the problems that they said, you guys have to do this if you are going to evolve as a business, okay? And then crucially, the biggest shareholder in Rivian is Amazon, who we pretty much know about Amazon. Back in 2019, when Jeff Bezos was still there, they decided they needed to move in tandem with the world to clean energy, and they run hundreds and thousands of trucks. So they signed a deal that said, and it came to fruition in 21, where they said, we'll buy 100,000 Rivian trucks, and hence the share price went absolutely bonkers. We'll buy 100,000 trucks over a 4 or 5 year period with a minimum of 10,000, on the assumption that if we don't buy 10,000 any 1 year, we have your exclusivity. You can't supply anybody else. If that falls below 10,000, you can go supply who you want. So at the moment, they're providing 10,000, but not at the levels that they were taking them up, that they wanted to take up, because obviously then the share price wouldn't have gone minus 52 to be plus 52. They've also got an amazing technology that the others aren't using. They call it the skateboard. If anybody's seen anybody on a skateboard, it all moves independently. It's got the suspension that levels, and you can go around corners and opposite cambers. That's pretty much their design. So it's a very unique design. And they can provide that technology to other companies as well. Now, the big thing here is there a potential end to Amazon's exclusivity? Getting a bit of feedback here, but is there going to be an end to Amazon's exclusivity? Because Rivian is at a point now where they are ready to produce, and they produce a small number of vehicles compared to the likes of Tesla. But they're talking to, the likes of Walmart. They're talking to DHL, companies and organizations who use enormous amounts of automotive delivery systems. And they're saying, well, Amazon, if you're not going to come to the party, and they got you in a contract, they got them in a contract, end the contract, and we want to go public and more public and sell to anybody. So there's a lot of conduits of potential opportunity for this company to ramp up its earnings. Okay, quality earnings means recognition by the market. It's happened in the last 3 or 4 quarters. And I'm taking the S&P, for example. If you miss your earnings, if your guidance is wrong, you get crucified in your share price on the trading day and thereafter. If you outperform or you hit the target, you get rewarded. So quality companies with quality earnings is the way to go. So these are the 3 that are in this basket that Societe Generale has put together. We put together with them, and I said, we're happy with this. Now let's have a little quick look at Societe Generale. We've actually got a complete, and Graham was very, very articulate on this webinar, where when the banking, some regional banks in the United States, as well as Credit Suisse in Europe, they failed. They effectively failed. They went out of business. And there was a lot of ripples. Is my money safe? Is this the end of the banking system as we know it? Is this the great reset that cryptos will take over? Is this the end of the world? Are we going to go back to barter and gold, etc.? So it has calmed down. There were some structural but not systemic problems in the banking system. But this is a credit monitor that IDAD, our structures in this particular product, all our products, use in terms of gauging how risk worthy these banks are of us putting our money with them. So if you hone in to a particular set of numbers here, on the left hand side you've got there's numbers, and on the right hand side it's the credit rating agencies who rate these guys, and they can get it wrong, but usually they're pretty okay. So that gives you your A rating. Cashbox will only look at an A-rated bank across the tier 1 investment banks that we look at with IDAD. So if you look at the little green arrow on the left-hand side towards the bottom, SocGen has got a metric of 89, 2 up, very, very big bank. HSBC's got a metric of 88. And the higher the number means the greater the risk we feel on that bank defaulting. Okay, in its obligations to its investors or its shareholders, etc. So the higher the number, the more risky it is. Comfortable with that, because if you go up and you have a look in the top block, if you have a look at sort of the Credit Suisses of the world who don't exist, but they're still there in name because UBS has taken them over, you're looking at ridiculous numbers of 168. Deutsche Bank, who also were well publicized that they had problems, and they have had for many years, 145. We won't go near that. We don't issue. We won't ask them for issuances, because there is the specter of potentially a higher risk in terms of them defaulting on their obligations to their investor, to their credit bonds, etc. So this is something we look at very carefully. The counterparty risk in who we are dealing with, who underwrites this contract, has to be around to make good the contract. We can't go off and have an outlandish bank somewhere in the world who nobody wants to deal with, who's going to offer you like 50%, because they're not going to be around in 3 years' time or 3 months' time potentially. So let's get to the fun part of this presentation. Then I'm going to hand over to Chad. We've dealt with issuing banks, software, and this is all in the rationale. It's all there on the invitation. I see this little tab there that's very clever. You can click on and see much more detail. So the issuing bank, we've dealt with the coupon. I still wipe my eyes and think like, man, 22%, 5.5%. That is just staggering. The term is a maximum of 4 years, but it can end early. The typical auto call. I'm going to come back to that. First new feature, 40% to earn your trigger. Normally, Cashbox normally aims at 50, which is quite a squeeze and an arm wrestle with the issuers. But thanks to Graham and the team, they know their stuff and they really do great things. We've got 40%. In other words, generate that income. We can have a 60% degradation. Those companies can go a further 60% up. We're still going to get paid the 5.5. I mean, that is really, really deep. That's what the ultra high level network families and investors want. Even if there's drama, they're still getting that steady cash flow, and that's how money makes money. Fantastic. So then drop down to the capital protection. That's another 40%, but there's another new feature there. So 40% is new, and then we have something called a geared put, and I'll explain that. So capital protection, we've also gone for 50. Now we've got 40. So we really have squeezed these guys for like deep levels of protection and easy levels of, once easy, but much more attractive levels of generating that income. So let's look at capital protection. That 40% is measured at the end. If it had to run all the way to 4 years, which I doubt very much, because we're going to go back to the auto call, which was all brand new, and we have a look at that. But if worst case scenario, and Chad's got a great slide on this, if worst case scenario happened and we went below that 40%, we've put in a feature. It's a particular instrument to mitigate further losses. Okay, and Chad will explain how it works. It's something that to me is an extra insurance should we get to that point. Okay, but personally, given where we are in the valuations, given what I'm now going to explain, I don't think we're going to use it, but it's there. It's peace of mind. It's been built into the contract. It's paid for. Thank you for coming. Again, that's what ultra net worths want. They want that extra, almost get out of jail card free at the end. So let's go back to the reducing auto call. Many of you on the call will be used to an auto call, which is the early maturity trigger, to happen at a point in time, which is contractually stipulated. And it's normally set at a percentage of the stock price of the shares, 90%, 95%, etc. Well, what we've done, we decided, let's get it reducing on a quarterly basis. So every quarter from 12 months, it starts at 90%, if you'll see there, of initial value, and then it reduces quarterly by 5% per quarter. So there's a great slide coming up. I'm not going to talk about it, which demonstrates this fantastically. It gets easier and easier to auto call. Okay, the bank wants to get out of the contract. It doesn't want to pay 22% years. Believe you me, the cost of capital is too great. Okay, and then it's got another new feature called the knockout feature. So what's the knockout feature? The knockout feature is, well, let me rephrase it. Normally, when you auto call, those in a normal basket, those 3 shares would all have to be above that certain threshold, let's say 90%, at that point in time, all 3. This particular program means that if any one of them is above and the other 2 are below, it knocks out. We don't have to worry about that again. We just have to worry when the ones are so that can happen at different times. Once it's happened, it's done. So there's a multitude overlay, like this onion that we've overlaid with skins of protection, which carries on right the way through. But I think the slides will really address this quite well. Availability, we've got until the 11th of June for your funds to be cleared on your platform, and so on, off we go. Now, minimum investment. This is something new, and I need to address it with you. We always come in with the paradigm of 10,000. And I'll use the analogy of a vehicle. When you go and buy a baseline model, a standard model that comes off doesn't matter which model it is, but it comes off as standard. And it's got 4 wheels and engine, doors, roofs, and all the good things, steering wheel, and etc. Off you go. When you decide, well, I'd like to have tinted windows, metallic paints, I'd like to have a certain type of exhaust system, or I'd like to have certain lights. Those are value-added products. And these specific additional protection, certainly protection, and the features that we've added in are basically these value-added products. So, with the bank, we've had to increase the levels in terms of contribution. So certainly it may be rich, but this is unfortunately the truism of the world, is that money does make money. And that's why maybe ultra high net worths can actually, with the economies of scale of buying power, can put these type of things together. But what I'm saying is, certainly at a retail space, this is something you ordinarily do not see Common or Garden pitching up on a regular basis. This is an absolutely amazing tactical opportunity for one's money rules, for one's consideration, to pay attention to it, because I certainly don't see that this will be coming out on a regular basis. We have the opportunity being invited in. This is something, when you see how the order calls work, and it's reducing and the knockouts, it's something that's certainly worthy of your consideration and your attention. So with that, I think I've probably waffled, and I'm going to be proverbially shouted at afterwards, but I'm going to hand over to Chad. Thanks, guys, for listening.
Cool. Andrew, always fascinating to listen to you. Hello, everybody. Nice to see so many online good people. So I don't know if you guys noticed, Andrew said he's got all...
Sorry, Chad, you're quite soft. Can you put your volume up a little bit?
Your voice might be soft. He's a hard taskmaster, though.
Loud and proud.
Can you hear me now? Can you hear me now? Okay, thank you. So Andrew did say he had the fun stuff. So I don't know what I've got to go through then. Maybe the unfun stuff. But it's important to understand where we are. So this reducing order call is really cool. So we're going to start off at the fourth observation, 1 year from now, at an order call level of 90%, meaning that the shares could drop by 10% and still the bank will take the product back, auto call it early. Then every quarter thereafter, it steps down by 5%, making it easier and easier and easier to auto call. In other words, get all our capital back. We would collect the last coupon at that time and then come out. So again, auto call all the way down to 40%. We've never seen this before. Well done, Andrew. Well done, Graham. Thanks, Jill. Now, in terms of the knockout feature, we've only had this once before. And what Andrew was explaining, this could represent 1 or 2 or 3 shares. As each one gets over the auto call level, from quarter 4 onwards, it's knocked out. We don't have to have that product get above the auto call again. It's done. And the product will run until the very last share of the 3 auto calls. So the product will still run until the 3rd auto call happens, or the 3rd share is above the auto call trigger, and then we'll close out. It could happen that they're all above at quarter 4, and we would have earned this fantastic return for the year and the product closes, or it could go on a little longer. Thank you.
Sorry, Chad, just to mention that also the capital protection barrier sits at 40%, that if it doesn't auto call.
Yeah, and then also you'll notice the auto call line is a straight line, but from quarter 4 it's actually stepping down, as Jill had in the previous graphic. So that auto call is reducing as well. Cool, thank you. Now, the geared put. This is so clever. Now, you'll notice that we're going to get our full capital out, even if the lowest of the 3 is at or above 40% of its start price. This is in the unlikely event the product runs to full term, right? But now look at this. The bank has then installed this geared put that they manage, of course. And as we go reduce by, let's say, from 40 to 30% to 20, I mean, it'd be crazy if any of these shares got there. But do you see the reduction in our capital doesn't step down on a 1-for-1 like it normally did? It comes down much, much slower. So at 30%, we'd get 75% of our capital out, 20, 50, 10, 25. That's the 2.1 time, or sorry, 2.5 times in terms of the reduction. So a deep level of protection for our capital there. deep level of protection for our income to make it happen. Very easy auto call all the way through the life. And of course, we've got the memory feature if any one of those shares was below that 40% in terms of returning its income. So literally the bath, the basin, everything has been thrown at this product. We've never seen so many features. So really well done, Andrew and Graham. Thanks, Jill. So just in summary, for those that may be new, again, as Jill said, we'd love to take you through deeper training and give more education if you'd like. But the sum total is the bank's got to be very comfortable with the stock options that they've put into the platform, into the basket. And they are very comfortable because it's against this that they're going to go and make their money. They've got to be very comfortable that the options that they've bought on those 3 shares are certainly going to pay the cost of the borrowed capital from us, because the contract says we've loaned them the money, they owe us that money back at that return, given these particular conditions are met. So as investors, we've obviously got to be very comfortable with the strength of the bank, and I think Andrew's demonstrated that. We've got to be very comfortable with the underlying stocks and that they're not going to more than halve. So we can go all the way to 60% reduction and our full capital would come back and our income. So all in all, a really, really interesting package with all the bells and whistles built in. Of course, as you guys know, and perhaps if you're new to this, we need an online trading platform to do this. This is a lovely setup. We do not touch anybody's cash. You're in full control of your cash and your platform. And on that, your platform obviously holds securities for you and provides your tax returns, etc., all your reporting. If you're interested, please reach out to support@Cashbox.Global. And what we'll do is we'll give you the ISIN number. That will be the reference number that you would use. And we'll certainly help you with your dealing ticket if you like to complete it. Of course, you sign it and you send your instruction. That way, we've got a certain allocation from the bank. And as we build up interest, it could be that we cap out in terms of our maximum availability before we close out on the 11th of June. And the last one, of course, what we'll do for our community we always measure how our product's doing. We always let you know how it's doing every quarter. So this is a wonderful asset to get involved with and not have to watch and look at trading screens every day. If you are interested, it's always a great idea to understand how those underlyings are doing and measure those every now and then. So a wonderful way just to park it for a quarter and let's see what's happening at that stage. We'll do that reporting for you.
Okay, well, thanks so much, Chad. And I think if we can open up for questions. If we have any questions, who's going to go first?
I think Ron had a question.
On the boxing glove slide. I like it.
Yeah. I can go back to the boxing glove slide. Let me reshare it.
Ronald, would you like to chat or do you want to pop a question in the box in the chat group?
Yeah, if I could just jump in here in the meantime, Graham and I had a quick chat online in terms of the actual product. You know, it went live a few days ago, I think the 15th, and Graham's got some interesting feedback in terms of, you know, this 40-40, you call it this, you know, 40-40 if you want to call it that, feature, and the headline sort of, you know, it is eye-watering. It's a fantastic return, has really grabbed attention. I mean, sure, you know, Cashbox is a global business, but there are other businesses that are, you know, jumping into this. I think, Graham, you mentioned there was a heck of a lot of interest coming out of the Middle East.
Yeah, that's
we've got a limited tranche, so we need to be aware of the caveats of limited supply.
Yeah, it's I mean, you know, look, Andrew, you've really have covered all the points as far as the rationale behind these shares. I mean, it's fantastic, but certainly, yes, I mean, the idea that we've got a limited space is simply because this has gone out on a general global release. But I think the big one for me, as much as the fact that there is a big concentration in the Middle East as far as the pipeline activity into this note at the moment, but really interestingly, it's the actual depth of the barrier and the knockout feature which has really captivated people's imagination. And I think the really sort of the big aspect on this one is that I think the last count we had was that more than 92% of investors are absolutely convinced that this will go no more than 2 years. So as much as we would like 22% on our capital per annum for 4 years, more than about 93% of investors thus far into the note see it as no more than a 2-year investment. So that it's that reducing auto call that I think has really excited everybody. Look, again, as I always say, I think I'd love the note to go full term and get 22% for 4 years, but it is what it is, and I think it is a very exciting opportunity, which again Cashbox has really come to the party and thought, yeah, this has got to be so fantastic.
Great,
Thanks.
thanks. So can we get to Ron's question? I'm just aware of the time because I know a lot of people need to hop off at the 7. Ron, what's your question? Ron.
Perhaps he's having a problem with his mute. Do you want to jump onto Glenn's question in the meantime?
Yeah. So Glenn asked, he said battery swap versus 1,000-mile range. Is this a VHS versus beta scenario where one will win, say Tesla, and NIO could potentially tank? Supply chains are still a long way from stabilizing. Do you see this as a 2-year play? I think there was your answer from Graham.
It's interesting. I'll just quickly jump in before Andrew does, because I know he's got way more information. But the issue with NIO, which was drawn to our attention, is that that NIO is going to be potentially a Chinese play. It could well be just a let's service the Chinese market. It's vast enough for the company to excel for at least a decade servicing the Chinese market alone. As much as Tesla obviously wants to get in on that market as well. But I think the issue with NIO is that it's not a question of, I absolutely get the question in the sense of the VHS versus beta. But the NIO has its own opportunities, both on a local scale and on a global scale. So I see no issues at all with the note being a 4-year term for those three shares. The fact that most people feel that it'll auto call within 2 years means that this is a absolute draw the line in the sand now and go for it.
Yeah, I think Graham, you knocked it on the head there. I think all I could add for Glenn is it's a little bit like the adoption of a hybrid model. I don't think there's going to be an overnight knockout winner in terms of the battery swap out or the holy grail of 1,000 or further mileage battery will exist. There will be a hybrid situation where it'll be a situation of maybe infrastructure can't get in to have a battery swap situation, like for example in the States or Europe or whatever. So I think it'll be it'll be regionally sort of it'll be a regional manifest, and I think you'll be able to choose. But essentially, at the end of the day, I think geopolitics also it's a bit of a left. In my actual rationale, I call it the left ball, and it's the curveball from the left-hand side of the field, because geopolitics could stymie business. I mean, we've seen what happened with TikTok in the States with the imposition of the Chinese ownership of TikTok. So will NIO even get going in the States? I don't know. Will it get going in other jurisdictions? I don't know, with these geopolitical headwinds. So, and that is why we need to make sure, the bank wanted to make sure as well, that it can get out of the contract by aggressively and steeply going down. I'll give you an example. On a retail note, when you see a reducing order call, it's normally 2.5% per quarter. This is 5% per quarter. It's hangover steep. It says that they're not prepared to pay this kind of cost of capital. So yeah, it's a great opportunity. As I said, for these companies to lose 60% from where they are currently, not impossible, but yeah, it could happen. You always got to have that health warning, but
Yeah.
it's a great entry opportunity, and that's why we wanted to park the miners, because intrinsically now we've had the Q1 results. You know, this is get in now and just they can bumble along. They can bumble along, quite frankly, because we are locked in the coupon, and we've now got this aggressive getting out of the contract from 12 months. So, it's a good question, but I think there's going to be a hybrid model ultimately, where I mean, in some jurisdictions, you know, the UK, I think it's 2030. You know, you won't be able to buy a new combustion engine.
No, that's
vehicle.
right. Yeah,
There's a hybrid at the moment. You can buy a hybrid or an old banger, but from a certain point in Europe and UK, that's it. And so you'll have to buy into whatever infrastructure supports it. Either it's a long charge battery or a charging swap-out situation. So it's a heck of an interesting space. And COVID and the lockdowns pushed us into this digital, you know, this asset space where things are changing really, really quickly. You know, either in clean energy, we had a clean energy note, and the guys aren't talking lithium anymore. They're talking, you know, the new thing is graphite batteries, hydrogen batteries. It's really interesting, and I think we're going to see a lot of change still coming.
Andrew, I see Ron's back. I saw his face.
Okay.
Ron, are you ready for your question?
Can you hear me?
Yes.
Yes.
Okay, fantastic. Sorry, I connected to somebody else's iPhone in the house, so I don't know. They were very confused when they were hearing you guys. Firstly, it's an amazing one, and yeah, geez, I wish all the other ones I was involved in had this level. It's like properly incredible. I've been sending my mates screenshots, and they're blown out the water, so I'm gonna have to deal with that later. The knockout trigger on the auto call level. If let's say Tesla is the first one that goes over the level, and it goes over at 90%, and Neo goes over at 70%, would that still count as 2 knockouts?
Yes.
So in other words, do all 3 have to go over at the same level, or if the one, you know, at year 2 months before we hit 4 years, if that was possible, we, you know, the last one went over at 60 or 70%, whatever the lowest number is. So they can all go over at any varying number. So first one goes over at 90, second one goes over at 70, or, you know, 85, and then the other one at 70.
Perfect.
Correct.
Yeah.
Wow.
Yeah.
Okay, that's proper.
Yeah,
Okay,
that's
cool.
absolutely
Thanks,
right. That's absolutely right, Ron. There's two points I want to make on. Number one is that within IDAD, we've actually got a bet going on at the moment as to which ones knock out first, because it's a little bit of a competition in that sense. So it really is a question of, you know, each one just will knock out, and then there'll be 2 left, and then there'll be 1 left, and then that's it. The note will call. And as I say, the general consensus is that we won't even get to 2 years before the note auto calls. The second point is that we had to fight tooth and nail with the investment bank to actually get the first observation in a year, because they wanted it at 6 months, because they actually feel that you know, that there is that much of a chance that this thing is going to auto call, that they wanted to get it to 6 months. So we had to fight to lock in for a year, because at least we can get 22% for you on an income stream. So, you know, that's the sort of challenges that we were up against here. But, you know, as Andrew said, he's been in this industry for, I don't know how many decades. No, I'm joking, Andrew.
He's young. He's so young.
But you know, it's not often you get this. And the features that we have pulled out are intrinsic in the nature of the shares that we're using, because, you know, let's be honest, there's some volatility there. Of course there is. But what we've done to protect capital in the first instance while maximizing an income stream is, I think, you know, pretty unique, and Andrew will certainly concur on that.
Great. Any other questions? I see Mark has got load shedding, so he's off.
Battery power.
Nice. Thanks, everybody. That was really good.
Yeah. Well, if there are no more questions, I will be sending out a mail tomorrow to everybody that had RSVP'd, just to let them know next steps or if they've got any other questions. If you would like a more of an understanding of structured notes, just let us know as well at support@Cashbox.Global, and we can set that up for you. And there will be a recording available. And then if you do need anything else, just give us a shout. And thank you so much for joining us.
Thanks, Jill.
Thanks, everybody.
Fantastic.
Cheers.
Thanks, guys.
Thanks,
Take care.
everybody.
Cheers, guys.